if I refinance my property and get some money out of it, are there any tax implications? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. You've just refinanced a property and you're going to be getting some money out. That's fantastic news. And a question I get asked regularly is whether this is a profit, whether I can take this money out, what are the tax implications? So let's dive into this today and have a look at what the implications are. So the first implication is you've just got a property, let's say it's 100,000 you paid for it, you've refinanced it and you're now getting 200,000 value for that property, having spent some money on it. So you've got some money coming back to you. Now this money coming back to you is potentially more than you've actually spent on the property. So in essence on that property, you're getting some of that equity out right now, rather than having to wait till you sell that property in the future. Now the key thing here is people think that this is a profit. Now this is not a profit because in essence you've not made that profit yet. You only make that profit when you actually sell the property. So in essence you've just got some cash out of that property to do something with. So is that a profit? Are you going to get taxed on that extra money? Let's say 20,000 that you've got out of that property. No, you're not going to get taxed on it. Because in essence, this is just an extension of the loan that you have just taken out. So if we go on 75%, you've now got a loan of 150,000, of which you only maybe needed 130 to pay off the purchase of the property, the refurb of the property, whatever it may have been. So you've paid the 130k, but you've now got 20,000 sitting in your bank account more than when you started. So that's a fantastic position to be in, but what can you do with that money? Now that really depends on what you've done with your property company. But the key thing here to start us off with is it a profit in the business? No. Is it taxable? No. However, this does create its own element that it's not money available for distribution. So we can't vote a dividend with this 20,000 to get it out of the company that way. So what do we need to look at of how we can utilise this money? Now the first way to use that money is always going to be reinvesting, buying another property, doing something else with it. So on that basis, that isn't going to have any tax implications because you're just using the money in the trade of the business to continue investing in property or doing such things. The bigger question comes when you say, well, actually, I want to take that money out of the company because I need some money in my personal name, not in the company name at the moment. And it's not just necessarily a matter of taking that money out, because if you just take that money out, there will be tax consequences, whatever approach you take, depending how you take it. So the first question I would like to say is, are you owed any money from the company? Now, for a lot of property companies I speak to, that probably may be a yes. You may have done training, you may have been doing viewings in different areas of the country to try and figure out where you're investing, or you may have been doing viewings. So you've got mileage to claim where there wasn't necessarily the money there to claim originally, but now you've got some money to claim. Or you may have been doing property training, which maybe cost you a few £1,000s. And again, it's an expense of the business, but you've not been able to take that money out of the business because there wasn't enough in the business to take. So on that basis, if you have a balance on your director's loan account or your shareholder's loan account, then you can take that money. There aren't going to be any tax consequences to taking that money, but only if you have a balance on your account. So you might have 10, 15,000 on the account. So you'd be able to take 10, 15,000 out of the company and there's no tax consequences. If, however, you have nothing on your director's loan account because you've not necessarily really had to invest too much just yet into the company, and you've already taken your deposit out because we've accounted for that in our 130,000, there may be nothing else that is owed to you from the company. So taking that money out would take you into a position which is overdrawn. You've taken more money out of the company than you should, which therefore means that you're in a negative position, and there are definitely tax consequences here. Check out the video on overdrawn directors' loan accounts and something called Section 455 tax, and that will take you through the detail of what those tax implications are. Hasten to add, at this point, there are tax consequences, and you just need to be aware of those, because it may be you're happy with those, or it may be you're not happy with those, but you just need to be informed. Other ways that you may be able to take that money out is if you've had the company for a while, you've got some dividends that you have been voting, or you're thinking of voting, and you may be able to vote a dividend, and then you can take that money out of the company. Obviously, with taking a dividend, there are tax consequences for you personally. So do check out the video on taking money out of your company, which explains what the tax consequences of taking a dividend out are. But that is one way of taking that money out. You will have to pay some tax on it, but then it's all legitimate and legal, and there are no issues. There's no overdrawn directors' loan accounts. There's no tax consequences from that point of view. Alternatively, there is the option of putting a salary through for yourself, but that only works in certain circumstances, depending whether you have a salary coming from elsewhere. Again, covered in more detail on the taking money out of your company video. The key thing I'd like you to take away from the video today is that if you make a profit on refinancing a property, it is not a profit. It is just additional loan. It is additional money in the company for the company to utilise. There are ways to take that money out of the company. However, you just need to be aware of whether you're taking out some money that is owed to you, whether you're taking things out as a dividend that maybe there wasn't cash there before to take, or maybe you're going to take it out as a salary and that's just the money there to take it out. However, all of these different things will have an impact on your profit and loss account and whether you are profitable or not. This money is literally money that will sit on your balance sheet. This is where your assets and liabilities will sit, not on what profit your company is making. So just take care when you're looking at this sort of thing. And if you do have any questions, make sure you speak to your accountant. They'll be able to take you through what you can and you cannot do. And then based on that, you'll be able to make the right decision so that you're not having any disastrous tax consequences that you weren't aware of. Hopefully today you've discovered what the implications are of taking money out of a property and what the tax implications are. If you have any questions, then please do leave a comment. Please like this video and please do subscribe to the channel. Let's make tax less taxing.